Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get sort of value or intent out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I just got back from the annual Veritas Housing Conference in Toronto. It's put on by Veritas Research, which is one of the leading equity research firms in Canada. Because they're equity research guys, they're not typically very real estate oriented or very real estate bullish. So it definitely allowed a whole different array of conversations. I gave a speech there, which I'm going to get into. I'll give you sort of my Cole's notes on my speech and roundtable discussion that we had there. But you know, the conference basically focused on the Vancouver and Toronto markets, and those two markets tend to basically mirror each other very, very closely. They have a lot of similarities. And what we're seeing here in Vancouver and Toronto, you look at again the month of September. We're nearing 30-year lows in home sales in Greater Vancouver. The only years that were worse were 2008, 2012, and 2018. All of course, incredibly weak years. So that's kind of what we're facing right now in the GTA. You have another month, another 20-year low in home sales, but what we're starting to see now, and where the conversation has been tilting over the last, several weeks and months, is that, as I gave in my presentation, is that, buyers don't like the prices today, but sellers don't like them either, and they're pulling listings off the market. In fact, if you look at new listings for Greater Vancouver in the month of September, we're at a 20-year low in new listings. In the month of September. That is incredibly low, again, when you adjust for population, housing stock, etc. So sellers are actually getting frustrated and pulling their houses off the market, and there really isn't a whole lot of great inventory out there. So you have this really weak sales demand. People don't want to pull the triggers, but the inventory situation is terrible as well. And so if you look at, for example, you're out there shopping for a detached house. So any detached house under $2 million, here's a picture of the inventory situation. The number of detached houses that are priced under $2 million remains incredibly, incredibly low right now. And so it's really hard to see, a massive sell-off in housing when you've got inventory at these types of levels and you're running at 20-year lows in new listings. And it's a very similar picture in Toronto, also running at 20-year lows in new listings for the month of September. So the idea that, there was just going to be this flood of people hammering the bid, flooding the market, can't afford their mortgages, and dumping inventory in the market has not played out. Now, again, it is extremely early. This is going to be a very interesting picture, I think, moving forward in the months ahead of how this plays out and how these interest rates slowly filter through. Because, what's rather ironic is that as the housing market now begins to tighten up because of this inventory situation, is that it actually gives the Bank of Canada more ammo to actually continue their rate hikes moving forward. Basically the Bank of Canada needs and wants house prices to come lower. They want to see some job losses. They want to see some softness in the labor market. They need lower growth in order to get inflation down. And so, the housing market being the largest pillar, if that starts getting ultra resilient and prices, start flatlining, it's basically a cue to the Bank of Canada saying that, hey, look, I guess the economy can handle higher rates, and we should just keep going until we get that slower growth that we need. And so that is the ironic catalyst. In fact, we actually had the Bank of Canada's Tiff Macklem come out this week and say exactly that. He says, let's clip to his thoughts right here.
Many Canadians have had their personal wealth tied up in real estate, with home prices basically increasing for the last 25 years. Now with housing prices in seeming decline, although I'm hoping many of the real estate agents in the room would disagree with me. Many people have used this accumulation of wealth, or at least paper wealth, in their retirement planning. What would you tell them to give them comfort if houses are headed down in price?
Well, we've been highlighting at the Bank of Canada for some time that high house prices and high household indebtedness to buy those houses, it is a vulnerability for the Canadian economy. In the last, through the pandemic, with the exception of the very first part, we saw a very hot housing market. And this was driven by a few things. first of all, the simple reality is we were all at home. We were all working at home. Our kids were studying at home. All our recreation was at home, and people wanted bigger houses. Interest rates were low, and we saw a real boom in housing, an unsustainable boom. Housing prices on a national basis were up slightly over 50% in the last 2 years. Housing has been unsustainably strong, and with the increases in interest rates, you are seeing that cooling. You are seeing housing cooling. That is part of bringing demand and supply back into balance in this economy. And you've seen some modest house price declines. Different parts of the country, it's different. The declines actually in Atlantic Canada, you didn't get as much of a boom. You aren't seeing as much weakening as some of the bigger markets in Canada, where we've seen more exaggerated movements on both sides. The slowing, housing could not stay as strong as it was. It was unsustainable. It needs to slow. That's part of the adjustment that we need to bring inflation down.
Okay, great.
Again, Tim Malcolm says housing needs to come down. It's funny, post those comments. The market's now pricing in a much higher odds of a 50 basis point rate hike in October here. The terminal rate, which is where they see the Bank of Canada topping out, also moved higher by 25 basis points. So the market sees the Bank of Canada now peaking rates at 4.25, which is 100 basis points higher than we are today. So imagine a scenario where, hypothetically, maybe we get there, maybe we don't. But if we actually do get that 100 basis point move, that takes your variable rate mortgage now to north of 6%. So again, it's rather ironic, because you're kind of, what I'm seeing in the housing market is you have this huge gap between buyers and sellers right now. Nobody likes the prices. The buyers don't like them. The sellers don't like them. The buyers want the lower prices. Seller wants the higher price. So nothing is getting done. There's basically no liquidity. And so you have this firming up, and it's basically giving the Bank of Canada to say, hey, well, house prices don't really seem to be going as fast down anymore, so we got to keep hiking rates. The economy can handle it. And so if you're a seller, it is rather ironic, because what we're seeing right now on the selling side is they're going, well, let's wait a couple months, let's wait till next spring and see what happens in the housing market. And I am struggling to see how a housing market improves with mortgage rates stuck in the 5s and potentially going to 6%. I mean, I'm struggling to see a scenario where housing improves until rates can actually move lower. So it's almost like we kind of need to just rip the Band-Aid and get this correction over with, so you can kind of move on with life here, because that's really the only way I think you get housing down or rates down, is if there is some sort of financial event, some sort of crisis somewhere in the world. And one of those ways to obviously push the Bank of Canada would be through lower house price. So it is rather ironic to see sellers are actually fighting it. But the reality is when you talk to people on the street and people that are selling their houses and realtors that are selling houses as well, is like there's a lot of people that don't necessarily know Tiff Macklem and how central banking really works and the goals that they're trying to achieve, right? Everyone's just in this belief that because it's been a 20 to 30 year bull market, it must continue, that any correction in these housing markets will be short-lived, and their sellers are clearly trying to wait it out. But like I said, I think the longer that housing sort of quote-unquote stabilizes, or at least doesn't succumb necessarily to these rate movements, it just reinforces the Bank of Canada's notion that they can continue to raise rates. And that's the same that goes for really the U.S. stock market, right? I mean, if stocks rally and start going up again, it's kind of like the thumbs up to the Fed and say, hey, keep raising rates then. Clearly the stock market and the financial markets and the economy can handle higher rates if asset prices are continuing to move higher. So we're kind of in this catch-22 right now. But we've actually got the Canada 5-year bond again now pushing higher, making new highs for this year. So you remember the volatility in the bond market has been extreme, and we've seen huge gyrations this year, and so now we're moving up higher again. So your fixed rate mortgages could very well start to push higher if these yields sustain at these levels. And then of course we know that another Bank of Canada rate hike is coming October 26th. That's going to push your variable up. So there doesn't seem to be any real relief in the interest rate space and in the mortgage market space. And so I think this is going to continue to push downwards pressure on prices. And I think rather ironically that sellers are trying to hold out and outweight. They're trying to outweight the buyers. And so this is kind of where we're at. This is this little standoff right now. But again, it's the same sort of thing in the U.S. We're seeing housing activity, obviously, slide lower. Mortgage rates in the U.S. are getting closer to 7%, 7% on your 30-year fixed in the U.S. And you can see that mortgage application volume has fallen almost 50% since the start of this year. So very, very difficult to buy houses with mortgage rates in the U.S. at 7%. And again, in Canada, at 5.5%, potentially moving to 6%, 16 plus year highs in rates. This is going to be a very challenging thing to work through. So that was sort of my thoughts on the market. The consensus from the event was more so a slow grind into next year on pricing, because you have this massive gap where both parties are digging their heels in, and sellers are so stuck on previous pricing. And the reality is, if you're putting your shoes in a listing agent's, if you're putting your feet in a listing agent's shoes, is that you can only push so hard. You can only push a seller so hard to convince them of market value today. So you can say, hey, listen, I think your house is worth $1 million. I know your neighbor used to sell at the top of the market for 1.25, but your market value today is about $1 million. No, yeah, Steve. And I say, well, let's list it at 1.1, gives you a little bit of wiggle room, and you should sell for about $1 million. What we're getting today is, hey, no, I still want to list at 1.2 or 1.25, and I won't take anything less than 1.1. And the reality is that you as a listing agent can only push so hard before people, you lose that confidence and trust in the agent that's representing you, and saying, hey, this guy's only pushing me, he only wants a sale. I've only been on the market for 2 or 3 weeks. I believe it's worth a lot more. I'm just going to go hire somebody else because if the other realtor down the street is promising he can get me 1.3, so I'll go hire that guy. And so this is what happens is you get in this sort of this tug of war even with the client. So it's always like this balancing, and that's why housing markets on their correction side tend to be more long and drawn out. You have to understand the psychology that's actually involved in these housing markets. They go up really fast because you get these fast bidding wars where house prices get repriced very, very quickly because buyers are emotional, and then sellers are equally emotional on the other side by digging in their heels. So housing tends to go very fast on the way up and much, much slower on the way down. So we had that initial gap down at the start of the year because there was that interest rate shock going from 2 to 5 in a matter of several months, and a whole bunch of people getting stuck with owning 2 houses because they bought at the top of the market in February and hadn't yet sold their existing house. And so they had to instantly dump those, and that forced those prices down. They gapped down very, very quickly. And we're past that part of that sort of panic selling. We're now more in this slow grind, this treacherous grind where 2 parties are batting up against each other. So that's the state of the housing market right now. I think, honestly, it's very frustrating, I think, on both the buyers and the sellers right now. I don't think either of them are overly excited. Because like I said, even for buyers, there's some decent deals out there today. You're able to negotiate certain houses and get decent pricing, but there's not a lot of inventory to pick from. There's still a lot of extremely stubborn sellers that are refusing to drop their prices. And if they are dropping them, they're not dropping them quick enough to match the market conditions. So hope that helped. Otherwise, see you next week.